We had a market that was all over the place today, but ultimately it was given the final verdict going into the weekend at the close was given to the Bears. So let's talk about what we saw today. Let's talk about what's important. Apple slides for okay, that's nothing headline. And talk about what we saw today. Talk about what's important and talk about what can happen going forward. We've got plenty of things to talk about today. So we had Apple earnings. They are showing slowdown in the U.S. This is not necessarily economic, although it could develop into something like that. It might be the preliminary starts of that, but ultimately the iPhone upgrade cycle is lengthening. That's why they're trying to push the services so hard, because they're trying to show that they don't need to rely on iPhones so much. iPhones are roughly 40 or 50% of the revenue. But that wasn't enough to take down the market. Apple wasn't enough to take down the market until the very end of the day, that final swoosh. My read on that was somebody had put a downgrade on Apple, and people finally snapped into reality. And we're going to talk about this snapping into reality trend, because it's important. You can see how delusional the market is. It's not like any new information came out. All that happened was somebody solidified reality for the markets. Somebody with an authoritative voice agreed with what I have believed on Apple for a very long time, and have had my face ripped off the past few months because of it. So, what actually happened today? We got this jobs report. The market, I guess, decided to take it as a positive thing. I viewed it as a very negative jobs report, like objectively negative. Why did I view it as an objectively negative jobs report? Because everyone's trying to cancel out the idea of a recession or say hard landing, soft landing, whatever. What about stagflation? What about that? It seems that Ray Dalio, who just happens to be the biggest hedge fund manager in the world, very successful person, does a lot of work, does a lot of publishing of books that you can read, and I have read and am reading. They're very good books. Just so happens to view stagflation as the most likely outcome. And that's exactly what we're seeing in the jobs report today. We're seeing fewer jobs added. We're seeing job growth decelerate. However, you would think that would mean that wages could finally come down, right? Less jobs being added, job openings coming down, quits are going down, wages. No, they're not. They are staying hot, and they're beating expectations. So we have job weakness, but labor price strength. That is a tint. I'm just going to say it's a tint because it's not extreme, but it's a tint. It's a very clear and obvious tint of stagflation. Whatever you want to call it. That's how I see it. And I think I'm very well reasoned in that assumption. So the market, I guess, decided to just look at a very modest beat on getting slightly less jobs added than expected, and decided to, for whatever reason, completely disregard the strength in, I'm not going to call them wages. I'm going to call them the cost of labor, which is typically the biggest cost for businesses, or at least a very, very, very major cost for many, many, many businesses. That's the truth. In many businesses that pay rent, it's a bigger cost than the rent itself in many cases. I'm not going to say all, obviously. Very diverse economy we have. So that kept the market up. Then we got hit with reality. Everyone is saying, or many people are saying, that inflation is softening, it's cooling, it's done, the Fed is done. This is where I think we are in for another dose of reality. And I think, if everything were well-reasoned, very logical in this market, I think would happen this time next week. That is obviously not the truth. The market is absolutely not always well-reasoned and logical. But whatever. What I think should happen next week is CPI comes in somewhat light for July. Why? Because prices have been moderating somewhat. And the catalyst for them to renew their upward trend, one of the two catalysts, we'll get to the second one in a second, oil prices, only really started to pick up in a major way towards the second half of July. So maybe it's not going to be reflected so much. So let's say CPI for July comes in rather light. Okay. I do expect it to be above 3%, which is our last reading. If you've seen the Bank of America information on this, basically as long as there's any sort of month-on-month increase, inflation is going to re-accelerate on the headline year-on-year number for several months now. But then, after an initial move, some sort of initial bullishness like what we saw today, I expect the continuing rise in oil prices to allow reality to sit in for markets. Why? Because the biggest contributor to the fall in year-on-year CPI has been retail gas, has been the fall in oil, has been the fall in energy prices. So, given that, we currently have a larger supply and demand deficit right now than we had at any point last year. And that is going to continue. I think we're going to be in for some reckoning here. We got a reckoning with Apple. We should have had it last quarter when we had consecutive quarters of earnings decline, revenue decline, all these things. The business has been shrinking for several consecutive quarters. That's the truth. But it was slightly better than expectations. That is ridiculous. Never care about expectations. Take that idea versus expectations and completely forget about it. Don't ever return to that idea again. Why? Because companies beat expectations most of the time. Even in terrible recessions and absolute financial catastrophes like the 07-08 recession and financial crisis. 60% of companies at the lows of beating earnings were beating earnings. So don't give a shit about beating earnings, okay? Apple just beat earnings. The stock's down 4.5%. We should honestly just completely disregard the concept of beating earnings expectations, especially when the concept of the whisper number exists. If you don't know what the whisper number exists, this is the reason why a company will beat earnings and the stock will fall. Because banks will put out their public earnings number that their analysts do for posturing. However, they'll tell their hedge fund clients and their big ticket clients another number, the truthful number. And that will be the number the hedge funds and stuff will use. And then the whisper number gets lower, or it's lower than the whisper number, and the stock goes down. So just totally disregard the earnings beating expectations BS. Just do that. That's my suggestion to you. You can do what you want. Sure, yes, there's great trades. Obviously, if you had Amazon calls, you obviously made money on that. Good for you. But it's just ridiculous. And just telling you, it's ridiculous. That's my opinion on it. Whatever. I'm just a dude sitting here in a room. So, we expect oil prices to go up. We think this CPI will be a little cool just because we're going to be defensive on this. However, we expect oil prices and base effects to contribute to a meaningful reacceleration in CPI. And I think the market has a bunch of reality it's got to wake up to. It started to do that. Fitch Ratings kind of did that. The rise in yields kind of started to do that. It still has to do it on the oil prices. And I'm definitely not taking a recession off the table. I mean, the economy, I feel, I would say I've got 95% certainty that the economy is going to slow from here, that we're not into some sort of, troughing. The market is very much expecting a troughing here. I don't think that's true. That's today's video, and until next time, peace out. And we've talked about why in past videos. Big debt crisis, student loans coming back on. Maybe we'll talk about it next time more in depth, but you can go to past videos for more of that. We talk about it a lot. That's today's video, and until next time, peace out.